Hi, it's Doc Severson for the Theo Night Report for Tuesday, February 7th. Now, I don't want to belabor the point because I've been going on the same tangent for several weeks now, and we're getting really no movement, but regardless of whether we look at the Dow, whether we look at the S&P 500, and zoom in here on the daily chart, we're seeing about the same thing, or even if we go into the Russell 2000 small cap, we're seeing the same thing across the board. We're seeing an extreme consolidation, a very tight pattern. This should have broken out to the upside a long time ago. Can't seem to do that, though. In fact, we have the Russell starting to sell down again at resistance one more time. And the Russell can be kind of that canary in the coal mine, which gives us the fund manager sentiment. Again, they can easily move these stocks. So if they're getting nervous about them, you'll start to see them tiptoe out of the Russell first before they'll start to move their larger cap stocks. So here's the problem. New highs are not being bought. We're very close to all-time highs, regardless of what chart you're looking at. But the new highs are not being bought. We're also seeing divergences in terms of the number of S&P member stocks that are above their 250-day moving average. So over the past several months, we have new higher highs, but we have lower highs in terms of the percentage of S&P members actually showing bullish charts. So what that means is just a few big studs are keeping things afloat. So if we go ahead and look across the different S&P sectors here in terms of today, you can see the red ones here. Actually, the VIX went down almost 1% today, which is really odd. Building materials are down today. We have energy down, and this is a real concern, the financials. The financials should be breaking out right now, and they are not. So financials initially went higher today and finished in the red. So some of the other stocks doing okay. Industrials are okay. Technology okay. We have consumer staples doing quite well. That's a very defensive play right now. So I think the best trade right now is still to expect to see the price building a slightly larger range. Right? So instead of just consolidating in this little microscopic range here, I think ultimately creating a larger consolidation range, which is going to include the formation of at least one red candle here. So we may actually see a red candle formation in the near future. This is going to kick off this larger range. Just don't know when it's going to happen. If too many people are looking for it, typically this is where the price will go the opposite direction, rope everybody in, make them chase after the price, and then the red candle prints. To me, the simplest trade to take advantage of this type of value creation would be a simple in-out vertical put spread. So we buy this for a debit and we fix our risk. This is a very simple trade to manage. And essentially what we're doing here is the concept of duration over direction. We don't know when this is going to turn down. We know eventually we'll be right. It's just we might be just a little bit early. So waiting for this to turn down gives us plenty of time. Should give us about a month for this to turn down, which I think is when I would expect to see the volatility, no later than a month from now. So another trade that I like a lot is coming up very soon. We've got Apple with an all-time high up here at about 134.5, and the price is about 3 points shy of that right now. And what I like about this is that we're seeing exhaustion on a multiple time frame basis. So not only the daily, but also the weekly is in extreme exhaustion. Now, what I mean by exhaustion is markets that go on these completely vertical tears. This is unsustainable. And we can see this all the time, right? So anytime we see one of these unsustainable tears, this is typically where we will see a consolidation, or at least some type of a pullback along the way. So every time this breaks out from the consolidation, runs up and goes vertical, this is where we see the exhaustion signal. We would expect to see some type of a pullback along the way. So we're coming up very soon to that level here. And a couple of trades that we can set up would be perhaps a short call diagonal, maybe even a low probability iron condor. So this is what one of these trades looks like, and what I want to do is I want to be patient enough for the price to get up to that level at about 134, so that should be close enough at that point. You know, this is like coasting up to a certain level and just touching that level and then probably fading back would be what I would expect to see from something like that. Now, first of all, if we set up a trade like this, we're looking for one-to-one reward to risk. Risk management is baked into everything that we do. It has to be. In this type of market where we have such low volatility, we have the potential for chaos, right? So we want to bake that in. We don't want to be sitting up at night wondering what's going on and watching the market move around in the Globex market and seeing, you know, these big gaps to the downside or anything like that. That will happen at some point, and we just need to factor that in with everything that we trade by putting basically unity, reward to risk in here, and setting that up as our major risk management is going to keep us high and dry from this. So this is obviously a bearish trade to the downside, but what you'll see with this trade is that if we show the Greeks here, this is going to have a certain amount of positive vega. And that's good because as the price kind of gets that level and starts to fade down, we should start to see a spike in implied volatility back up again. What this is going to do to any time spread is this is where it's a little bit different, is that it will actually change the expiration profit and loss graph here and slightly bias that to the downside. It will actually grow. Now, the opposite thing can be seen is that if you enter too early into a time spread, you could actually see that same P&L graph actually shrink down on an expiration basis, and that's what you don't want out of a time spread. But if you wait for the right time for a time spread, then this can actually work in your favor. So all we really need is a very quick little move down here, and we're easily looking at about 50% return on capital profits for this type of a trade with very little time. So usually the hold time for these is about 10 days or less than that. So in this type of market that we have right now, where we have very low implied volatility, we have to be very tactical. We have to be very precise with how we trade and look for edge and look for opportunities where they arrive. We can't be just sitting there selling iron condors with wings that are hundreds of points out of the money, you know, unlike years ago. But the whole point here is you got to be proactive. You have to be anticipating these sort of setups. You can't wait until they show up and then say, oops, there it was. I missed another one. So be organized, be proactive. We're not trying to predict the future. We're just anticipating the probabilities of specific reactions. That is it for today's report. Thanks for listening, folks. See you tomorrow.